we're jumping straight into Sky Quarry today. Everyone is watching the recent price action, and it's been painful.
Absolutely brutal.
But the real story here isn't the current value. It's the major push, this huge pivot toward non-dilutive capital through a new $100 million digital asset strategy.
Right. They're trying to tokenize their assets.
And that's the pivot we really need to understand right now.
That's it, exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
If you're enjoying the show, make sure to subscribe and hit that like button. It really, really helps the channel.
It does.
And please let us know in the comments which stock you want us to break down next.
All right, so let's get into it. The bull and bear case for Sky Quarry. This is, it's a story of extreme short-term risk versus, well, massive long-term potential.
And it's all centered around this unique technological moat they have.
Mm,
We have to start with what they actually do, because it's not what most people think.
not at all.
They take waste asphalt shingles, the stuff clogging up our landfills, and they convert them into recoverable oil and aggregates.
And they use a proprietary closed-loop extraction technology to do it.
The scale is what really stands out to me. They estimate they can convert 15 million tons of annual U.S. landfill waste
Which is just a staggering number.
into 20 to 22 million barrels of recoverable oil. That is a massive and sustainable feedstock source.
And that proprietary process, that's their true competitive moat. It positions them in, like, sustainable, heavy crude refining.
Which is a whole different ballgame.
It completely differentiates them from traditional oil producers who are just drilling. Sky Quarry uses this lower-cost feedstock that's literally derived from remediation, like oil-saturated soils.
So they're protected from head-to-head competition in that sense.
Exactly.
Yeah.
And operationally, their Nevada refinery has a decent capacity. We're talking 4,500 to 5,000 barrels per day. So the tech works.
Okay, so the tech works, but here's the mixed picture, the financial reality.
Right, the numbers.
On the plus side, recent results show some really good growth momentum. Q1 revenue was, $6.86 million?
Yeah, and then Q2 jumped to $8.06 million. That's a 38% quarter-over-quarter growth.
Which is strong. And their revenue is pretty diversified across liquid asphalt, diesel, and VGO.
Yeah, about 43% asphalt, 29% diesel, and 26% VGO. That diversification is healthy.
But looking a little longer term, their 3-year growth was strong at 101%, which suggests the current operations are a sharp turnaround.
But, and this is a big but, the near-term financials are where you need to be cautious.
Very cautious. The company reported a 47% annual revenue decline last year.
And profit margins are getting squeezed by refining costs. Plus, cash flow is negative because they're plowing all that money back into scaling their assets.
Right, like those PR spring bitumen leases.
Exactly. So the market is pricing in all this weakness, which, that creates its own potential opportunity.
Yeah, that's where things get interesting. The price-to-sales ratio is notably low, just 0.4x.
Which is a huge flag for potential undervaluation, especially compared to industry averages.
So let's address the elephant in the room, the immediate risks. That 47% revenue decline is worrying, and the stock is trading around 40 cents after an 81% loss year to date.
Ouch.
And then there's the NASDAQ compliance deadline coming up in March 2026. They need to get back over that $1 minimum bid.
Yeah, and then you have to look at the balance sheet. There's a definite vulnerability there related to debt.
You're talking about that recent settlement.
I am. They just settled about $491,000 owed by a subsidiary, not by paying cash, but by issuing over 1.47 million new shares. And while, okay, it stabilizes the balance sheet by getting rid of debt, issuing those shares causes dilution.
And dilution eats away at existing shareholder value. It's like cutting the same pizza into more slices.
That's a perfect analogy. Your piece just got smaller.
Okay, so this is where it gets really interesting. The major forward-looking catalyst is how they plan to get funding without more dilution.
The $100 million digital asset strategy, the DD.
This is their big pivot.
It is. This strategy is focused on real-world asset tokenization-RWA. They're partnering with a firm called Continuum.
So explain that. What does that actually mean for an investor?
Essentially, they're looking to create oil asset tokens that are based on their physical holdings and their operations.
Like digital versions of their oil reserves.
Pretty much. And this could let them raise capital in a non-dilutive way. Instead of selling shares of the company, they sell tokens backed by the assets themselves.
And there are even some speculative rumors about them launching an RWA exchange platform.
Now, that would be the game changer. That could unlock really flexible capital, and maybe even let them use their waste recycling operations as collateral for suppliers.
So that's the crucial variable. That's the thing that could totally re-rate the stock.
It is
So let's look at the charts, the recent price action. That 30% monthly plunge means the stock is highly oversold.
deeply oversold, yeah. It looks like it's formed a potential base, with technical support holding between about 35 and 40 cents.
And that oversold status, when you combine it with that low 0.4x PS ratio.
It suggests that a lot of the bad news, maybe all of it, is already priced into the stock.
Right. But we do see some institutional interest, though it's not massive.
Oh, but it's there.
Yeah,
JP Morgan Private Bank holds about 9.65% of the shares. That's not nothing.
not at all. So while the overall mood is cautiously negative because of those revenue drops.
Any positive news on the tokenization front could quickly reverse the momentum indicators and the volume. It's coiled like a spring.
So wrapping this all up, what does this all mean for you? Sky Quarry is an early-stage turnaround story,
A high-risk one.
driven by a really powerful environmental moat. The near-term risks are the revenue contraction and that NASDAQ deadline.
For sure. But the $100 million digital asset strategy is the real swing factor. That's the thing that could completely change their funding profile.
The timeline here is tight. We're looking at the next 1 to 3 months for news, with that March 2026 deadline in the background and Q1 earnings updates coming.
So the question for you, the learner here, is this. Can the promise of this non-dilutive digital asset future, can it outweigh the very present risk of their historical revenue decline?
That's the tension. That's what you need to watch.
It really is.
That's the lowdown on Sky Quarry for today. If you haven't already, subscribe so you don't miss our next breakdown.
We'll see you on this one.